Hello, and welcome to Virtual Investor Conferences. My name is Cecilia Schoenbaum, and on behalf of OTC Markets and our co-sponsor, Murdoch Capital Partners, we're very pleased you've joined us for our next presentation from Skeena Resources. Before I introduce our speaker, a few points to note. Please submit your questions in the questions box to the bottom left of the slide. Once the Q&A session is ended, don't log out. You will automatically be transferred into the Skeena booth, where you can continue to ask questions via chat and access additional shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Kelly Earle, Vice President of Communications for Skeena Resources, which trades on the OTCQX Best Market under the symbol SKREF and on the TSX as SKE. Welcome back, Kelly.
Thank you very much, Cecilia. And thank you, everyone, for joining me today. We're going to be talking about Skeena's Eskay Creek project, which is a past-producing gold-silver mine in the Golden Triangle of Northwest British Columbia. And then I will also briefly touch on our past-producing Snip mine because we just released a resource for that asset. So we'll move past the forward-looking statements and on to our property locations. We have two projects currently in the Golden Triangle of British Columbia, Snip and Eskay Creek. They are both past-producing mines, and as I mentioned, our focus and our flagship asset is really Eskay Creek. So moving on to the Skeena team, since my last OTC presentation a few months ago, we've had a couple of additions to the board and management team, so that's what I'm just going to touch on briefly. First would be Shane Williams, who's a new Chief Operating Officer and engineer that we've brought on board. Shane was formerly with Eldorado Gold, and he brought what was Integra's Lamaque project through to production. And he also has a lot of experience with open pit projects in the north. For example, one in Greece called Olympias, which has a very similar deleterious element to Eskay Creek. So he's a wonderful fit for us as we move from an exploration company through to the development stage and on to production. And then finally, we have a new addition to the board of directors as well. That would be Greg Beard. He just joined us earlier this week. Greg was formerly with Apollo Global Management in New York and managed assets. So he's a wonderful addition to the board as we look to take Skeena further, and especially since we're investigating a New York Stock Exchange listing for the future. I would also note that we are graduating from the TSX Venture Exchange and going to the TSX main board, and that should happen at some point in August. So I'm going to move on now to the infrastructure in the Golden Triangle, and this is a slide we always like to talk about because there have been such huge improvements in infrastructure in the Golden Triangle since both Snip and Eskay were in production in the 90s and early 2000s. Most important of which is 3 hydroelectric facilities that were built between Snip and Eskay Creek within the last 10 years. And the Volcano Creek hydroelectric facility is only about 7 kilometers down the road from Eskay Creek. And our PEA envisions tagging into power there at 6 cents Canadian per kilowatt hour. So extremely inexpensive power. When Snip and Eskay were in production, it was fly in, fly out, diesel powered, and about 50% of the operating expenses at Eskay were fuel. So because of the vast improvements in infrastructure and inexpensive power, it greatly decreases the cutoff grade at which we can mine at Eskay. So a bit of a quick overview of Eskay. Again, very famous, historic, past-producing mine. Produced 3.3 million ounces of gold and 160 million ounces of silver at an average of 2.5 ounces per ton. So it was the highest grade gold producer in the world when it was in production. Very important to note the cutoff grades. When the mine started operation, it was all direct shipping ore, and there was a 30 gram per ton cutoff grade while they were wait to building the mill. So that meant anything below the 30 gram per ton cutoff grade was considered waste. And then when the mill was built, the cutoff grade dropped to 15 grams per ton. So our thesis was pretty simple. What was left behind that was below this extremely high cutoff grade that was not economic when the mine was in production, that would be economic now. Before I get into the resource, I want to talk about the deal terms on Eskay Creek. Very exciting. We've just renegotiated our deal terms with Barrick a few weeks ago. So the original option terms saw us optioning the project in December of 2017. It was a 3-year option. The only commitment was to spend $3.5 million in the ground, which we did within the first 8 months. The next hurdle was to acquire 100% by paying a $10 million purchase price, posting a bond. And then the final piece was that Barrick had a back-in right for 51%. where they could spend 3 times our cumulative expenses to come back in. And that was a 12-month window for which they could decide if they wanted to come back in. So that, created a bit of uncertainty around the stock and the share price, and we were aware with that. So we approached Barrick and asked if we could renegotiate. And I'm happy to announce that we've signed a binding term sheet, and the definitive agreement is being worked on as we speak and should be completed shortly. So this sees Barrick extinguishing their back-end right completely and becoming a shareholder in Skeena. So in exchange for them extinguishing their back-end right, we gave them 22.5 million units. So that is comprised of shares and half warrants. So once the deal is done, Barrick will own 12.4% of Skeena. If they exercise their warrants, that would bring in $30 million of cash. It's a $2.70 strike price, and then they would own approximately 17% of Skeena. So we're very excited about this deal because it completely extinguishes the back and right, and will mean that SK Creek will be 100% ours shortly. In addition to the units, Barrick also has a 1% NSR on the entire land package, a right to appoint someone to the board of directors, and we've talked to them about putting a mine builder on the board, someone with engineering and development experience, and they're open to this, so we're looking for a new board member to join from Barrick. And then finally, they have pro rata rights to participate in future Skeena financing. So I'll quickly touch on the mineral resource. We put this out in November of last year. It's an open pit resource, so very different than historically, which was all underground. The majority of the current resource is all open pittable. There's about 300,000 ounces by that NEX zone that we didn't push forward to the PEA, but the rest is open pit. There's the 21 main pit and then the 22 zone satellite pit to the south. The current resource is sitting at 4 million ounces at 4.4 grams per ton, and that's the combined indicated and inferred grade. It's important to note the grade difference between the indicated and inferred. The indicated is sitting at 5.9 grams per ton gold equivalent, whereas the inferred is only sitting at 3 grams per ton gold equivalent. And as I've mentioned before, this is largely a function of drill spacing. Indicated spacing is very tight. It's where it was mined historically, 10 to 15 meter centers. Inferred drill spacing is more like 50 to 75 meter centers. So we're busy doing infill drilling as we speak. We have the drills started spinning again in July. We've got quite a bit of drilling planned from now until the end of the year. And our prime target is to take all these inferred ounces. So there's 14 million tons in the inferred. We need to bring them up to the indicated category so we can push forward with the pre-feasibility study, which we've already started. And our target completion date is the first half of next year. And as we're doing the infill drilling, we're noticing that we're able to give certainty and actually increase the grade, which means adding ounces. So we're at 4 million ounces at 4.4 grams right now, and our target is 5 million ounces at 5 grams. And I'll show a cross-section in a second that will demonstrate some of the success we've had and why we think we're going to be able to get to that 5 million ounces. The next slide just highlights the PEA that we put out in November of last year. 9-year mine life, producing and shipping a straight concentrate to smelters, producing 306 gold equivalent ounces per year. 306,000 gold equivalent ounces per year. Average grade would be 4.17. I would note that all these numbers that you see here are done at $13.25 gold, which is what gold was closer to when we did the PEA. If I go to the next slide, you can see that was our base case. If we move to our higher case today, 1,700 gold, you can see the after-tax NPV at a 5% discount goes to $1.2 billion, and the after-tax IRR jumps to 76%. This is a wonderful asset in a rising gold market because it's just so high grade at 4.4 grams for an open pit. But also our downside is covered because it is so high grade. So this is still the kind of deposit that would work at $1,000 or $1,200 gold. But I'm hoping that we can all agree that we think gold will go up from here. So next, I just wanted to quickly touch on 2 aspects of the mine design: the existing TSF, which is the tailings storage facility, and the former waste dump. So the TSF and the former waste dump are both dead lakes or non-fish-bearing lakes. All the tailings were stored subaqueously. This is where we envision putting all the tailings from the PEA, and there's ample storage capacity. And most importantly, this is already a permitted discharge point under the Mines Act. So it's very beneficial that this is a brownfield site. We won't have to go through the full environmental impact assessment on the entire project, only certain aspects of it. We're actually working that out with the BC government, Ministry of Mines right now, and our Tal Sand First Nations partners to determine what aspects of the mine design will have to go through the full EA process and what can be fast-tracked because it is a brownfield site. As for the former waste dump, I mentioned the cutoff grade was 30 grams per ton for the first few years of mine life. That meant that anything below 30 grams per ton was put into this lake, Albino Lake. You can actually fly over it and see the dump. So we estimate there's several 100,000 ounces sitting in this lake. So this is another way we're going to add ounces to the deposit and hopefully get that 306,000 ounces a year up closer to the 500,000 ounce mark. That would be our long-term target. So this is an area, this former waste dump, that we'll drill off probably next summer to really get a handle on just how many ounces are left behind there. This is just a slide to show some of the current upside potential. In gold is our current resource. All the blue dots are the historic drill intersections, anything greater than 4 grams or over 2 meters, as we think that would be the minimum mining grade in width. You can see that there's a cluster under the 22 zone. So these would be deep feeder structures that were considered to be too low grade by the very high cutoff grades when the mine was in production, but they would be considered high grade by today's standard. This is one of our main targets below the 22 zone. Also parallel to the main pit, the 21 zones. And finally, the depth potential of the project not yet known either. We've actually started drilling in an area right beside the NEX called the Water Tower Zone. And this is an area that we've not drilled before that'll have some really exciting exploration potential. It's another feeder structure, and we should hopefully have some first drill results out from this current program later in August. But I'm going to show you a quick cross-section through the 21A zone now to show some of the great results that we put out at the end of last year. This just gives you an overview of the deposit. There's a basalt cap, there's a very high-grade contact mudstone layer in the dark orange, and then a slightly lower grade layer in the rhyolite in the lighter orange. You can see the resource pit limits here. We were doing infill drilling. All the white dots are historic drill holes. You can see we plugged 2 drill holes in between the white dots and tagged into 27.61 grams over 9.4 meters, 17.49 grams over 7.5 meters. And importantly, we're able to fill in that gap. So that's how we bring it from inferred to indicated, give certainty to the grade, actually increase the grade, and that's how we're going to hit that 5 million ounces at 5 grams per ton mark. The most exciting part about this slide was the few exploration drill holes that we let go below the current resource pit limit. And this is where we tagged into 314 grams over 2.21 meters. Excitingly, this is in a new lower mudstone horizon. So the contact mudstone horizon up above is the extremely high-grade area that was mostly mined out historically. The lower mudstone horizon represents where the seafloor would have been earlier in the life of the deposit. So this is a VMS deposit, which simply means that it represents the seafloor. We have hot fluids coming up in the rhyolite feeder structures. They hit the cold ocean water. You get the main deposition event. That's that contact mudstone horizon. This lower mudstone horizon represents where the seafloor would have been, say, 1 million years earlier. So we're pretty excited because there's next to no drill holes in here. This is one of our main targets for exploration drilling that we've started to do and will continue throughout the year. So hopefully we'll have some pretty exciting drill results coming out later this summer. Next, I just wanted to quickly point out what a spectacularly high-grade asset Eskay Creek is. So this slide shows average grade open pit development projects in North America and Australia. That's the top chart. The bottom chart is worldwide. You can see the average is 1.5 grams. Eskay Creek is sitting all the way up at 4.3 grams, so extremely high grade for an open pit, and we have goals to bring it to 5 grams per ton, which would make it one of the highest grade open pits in the world when it gets back into production. Next, I wanted to talk about our market cap and our price to NAV. So we're currently sitting just over about a $500 million market cap. And below that, you can see our price to net asset value ratio. We're trading at about a 0.4 times multiple right now, which we would argue is fairly low, and that a 4 million ounce, 4.4 gram per ton open pit deposit in a very safe mining jurisdiction should actually be trading at a premium. We've got a long way to go to continue marketing and some infill drill results, and pushing it along towards the PFS we think will help bring it up along this curve. And some exploration drill success wouldn't hurt either. So we're pretty excited about the results that'll be out later this year. Next, I wanted to talk quickly about our plans for Eskay Creek for the rest of this year and into next year. We're in the middle of an infill drill program. We have 68,000 meters to do. I think we're about 5,000 meters into this so far. So drill results will start coming out in August, hopefully. In addition to that, we'll do 20,000 meters of exploration drilling. So we've got about 88,000 meters of drilling to do through now and the end of the year. We're fully financed for this. We have about $45 million in the bank right now. So that will take us through our drilling and also through to our pre-feasibility study. So our goal for the pre-feasibility study, which we've already started with Ausenco, is to have it out in the first half of next year, followed by the full feasibility study at the end of next year, and then we would push forward with construction starting in Q1 of 2022. So that's our plan right now. That's kind of our base case, and we're going to see if we can try to expedite that. In addition, we've got metallurgical and geotechnical optimization test work underway. We've received life of mine concentrate contracts already for the concentrate we'll be producing at Eskay. That's what we base the PEA on, but we think we can improve on those. So we're sending concentrate samples to smelters around the world to get quotes, so that's underway. And of course, we've already started the comprehensive environmental studies required for the permitting process. One of the nice things about having a brownfield site is having about 30 years worth of environmental data. So that very much expedites the permitting process. So that's a very quick overview of Eskay Creek. I briefly wanted to touch on our Snip gold project because we just released an exciting high-grade resource for this asset. So we own Snip 100% outright. We have the same kind of option deal with Barrick for Eskay as we did for Snip. We exercised it, we posted a bond, we own this 100%. I would note that Hochschild Mining has an option to acquire 60% of this asset, and they can come in for 60% by spending 2.5 times what we've spent in the ground on Eskay. So Hochschild hasn't pulled the trigger on this yet. They're excited by the asset, but they'd like to see a bit more drilling and to see the 200 footwall zone expanded a bit before they pull the trigger, and their option expires in October of next year. So again, Eskay is a very high-grade past-producing mine, produced 1.1 million ounces at about 28 grams per ton. And once again, we did inherit a lot of historical work, and because those cutoff grades ranged from 12 to 24 grams per ton when the mine was in production, it was the same thesis as Eskay. What was left behind that was not economic when the mine was in production, that would be economic now. So we just released a maiden resource for this, and the current resource between the indicated and inferred is sitting at 646,000 ounces, and the average grade is about 13.5 grams per ton gold. So this is an all gold deposit. It's a very different deposit than Eskay Creek. It's narrow veins that pinch and swell, but it is a pure gold deposit, and it's extremely high grade, and it's very clean ore. So Eskay Creek is known for its mercury and arsenic, and the first 3 years of the mine life at Eskay, we do pay minor smelter penalties for the mercury and the arsenic. So one of our thoughts was, would it be possible to combine Snip and Eskay together? And we're actually looking at this now with our engineering and mining teams to see if it would make sense to truck the ore, which is about 45 kilometers from Snip to Eskay. There's a bit of a gap in the road that we would need to build, but we've already received the permits to build that. So this is what we're investigating right now to see if it would make sense to combine the two projects and bring high-grade ore from Snip over to Eskay. We'll probably know the answer to that question later in the fall, and I would say at that point it's probably time for a decision to be made on Snip. Is this something that makes sense to keep and combine with Eskay, or is this an asset that we should spin out into a new company, or is this something that we just sell outright with the option from Hochschild still attached to it to bring in funds to push Eskay Creek forward non-dilutively? So those are questions that I unfortunately can't answer yet. The first step was the resource, and then we will look at if it makes sense to include Eskay and Snip, and we should have the answer to that later this year. But we will be doing some drilling at Snip this summer. Excitingly, we're looking at a new area called the 200 footwall zone. And this is where we got this extremely high-grade hit last year, 1,131 grams over 1.5 meters. So on this cross-section, the blue on the right-hand side is the production of the historic twin zone, which was mined out. That produced about 700,000 ounces at 29 grams. So we're looking for the other side of the shear zone, which is called the 200 footwall, which we tagged into with some surface drilling years ago. This is the really exciting hit that we put out last year. So this is our key area where we'll be doing some drilling later this summer. We hope to start up within about a month or so, probably about 5,000 meters of drilling at Snip. This will really give us a handle of the size of the 200 footwall, how many more ounces it could add to the resource, and that'll feed into if it makes sense to combine Snip and Eskay together. So the last thing I wanted to touch on was our relationship with the Tal Sand, which is the First Nations group we work with. Skeena and the Tal Sand are founding members of the British Columbia Regional Mining Alliance, the first of its kind, a partnership between industry, First Nations, and the British Columbia Ministry of Mines. This has been very successful. We've traveled the world promoting mining investment in the Golden Triangle of BC. We're excited to have the Tal Sand as our partners on this project, and I hope to have some more exciting news to announce about our Tal Sand partners later this summer. Finally, our capital structure slide. Skeena's share price has performed very well as of late. We're sitting just over a $500 million market cap, 171 million shares outstanding. After the Barrick deal is done and we own SK 100%, we'll have 193 million shares outstanding. So again, we've performed well, but we think we've got a long way to go to really show the true value of having such a wonderfully high-grade asset in a safe mining jurisdiction. So that's it from me for the presentation side. I'm going to take a look at the questions here. So the first one was, have you recalculated NAV using gold spot as of today? So I think the last time I plugged it into the model, it was 1900 gold and about 1850 silver, and the after-tax NPV at a 5% discount was about 1.3 billion, and the after-tax IRR was over 80%. So yes, it's a wonderful deposit for a rising gold market. Next question. Why would Barrick decide to sell the rights to SK Creek? So this is a good question and one that we get quite frequently. And the reason being is Barrick is looking for tier 1 assets, what they call tier 1 assets. So tier 1 assets are 5 million ounces producing 500,000 ounces or more a year. And we're currently sitting at a 4 million ounce deposit that could produce 306,000 ounces a year. So we're below what Barrick would consider to be a tier 1 asset. So Barrick was happy for us to continue pushing SK Creek forward to potentially get it to the size where they would consider it to be a tier 1 asset, and then they could, potentially buy out the company. So they were happy to take a large share position. So they will own 12.4% of Skeena once our deal is done, which should be within the next few months. So they'll kind of have a toehold in the company. They can keep an eye on things, and if it ever does get to the size where they would be interested in taking it over, then they have a good position with which to do that. I would also point out that, Barrick doesn't have a team in British Columbia currently. They're not as familiar with the political jurisdiction, the First Nations groups here. Skeena has built a very strong team with a lot of experience working in British Columbia. So we really are the right team to push SK Creek forward, and I think Barrick recognized that. Mark Bristow actually mentioned SK Creek on his last earnings call and said he was happy with the team that was pushing it forward. So we're excited to have them as a shareholder, and potentially in the future, it could become a Barrick asset. So next question, would a spin out of Snip add shareholder value given the markets currently give little to no value for its high-grade resource? So this is a good question. I think I kind of already answered it. It's a bit too soon to tell if it's time to spin out Snip. We really want to see if it makes sense to add the high-grade ounces from Snip to SK, because that could add a substantial amount to the NPV of the project and bring more high-grade clean ore in as well. So maybe in the future it would make sense, or it would make sense to sell it, but it's just too soon to tell, and this is what we're evaluating currently. We hope to have an answer by the fall. Just scrolling through the questions here. With approximately 25% of SK resource in silver, would it not be beneficial for Skeena to promote the silver production outline in the PEA to the markets? So we always push for gold equivalent ounces. So when I say 306,000 ounces, those are gold equivalent ounces. And as the silver price is rising as well, there will be more value added from the silver. That is correct. So I envision that when we do the PFS, which will be in the first half of next year, that we will probably see more value put on the silver. Yes. Just scrolling through some more questions here. Is ore sorting a possibility with Snip to reduce transportation costs? So it's way too soon to talk about ore sorting possibilities at Snip. We put out a first resource, so that doesn't look at the economics or the mine plan at all, but this is definitely something that our engineering team will take into consideration as we look at combining Snip and SK Creek and the potential of that happening. So I'm just seeing if we have any more questions here. When do you plan to update the SK resource? Will this happen before or coincide with the PFS? So we have an in-house resource geologist, Kathy Dilworth, wonderful resource geologist, and she is actually looking at updating the resource as we have drill results coming out later this year. So of course, there's always going to be a bit of a lag, but our goal is to complete the 88,000 meters of drilling that we have planned for the rest of this year. So that's all our infill drilling, which we need to complete to do the PFS. So complete all of that, about 20,000 meters of exploration, and have the resource updated end of this year or towards the beginning of next year, and then that updated resource would feed into the PFS. So I predict we'll probably have an updated resource out at the beginning of next year, and then the PFS out in the middle of next year. So that's our plans there in terms of the updated Eskay Creek resource. Who are the main shareholders in Skeena? That's a good question. So the majority of our shareholders are actually institutionally held. We have a group out of New York called Luxor that's one of our largest shareholders, over 15%. The other is a family office, a fund out of Heidelberg, Germany called Deutsche Ballantine that owns about 17%. We have a few other Swiss-German funds, Concept Capital Management and Gold 2000 that are some of our largest shareholders. And then the rest of the institutions are all more in the few percent range. And excitingly, we've just had a couple of generalist funds come into Skeena. So I think we're at the stage now, and there's enough excitement in the gold market that generalist funds are starting to come back in. So we're excited about that, and we'll hopefully have more of that as the price of gold continues to move on. Okay, I think that is all the questions. I think that is all the time I have questions for right now. One last one, sorry. What is the 2020 budget for Snip? So we have about 5,000 meters planned for drilling at Snip. So the price on that is about $2.5 million. So that should start within about the next month. And then we'll hopefully have some nice high-grade drill results out on Snip later in the fall. So I think I'm going to end it there. Those are all the questions that I have in my queue. I think we'll automatically jump to a chat session after this. So if anybody has any more questions that they didn't want asked live on the chat, then please come to the chat session afterwards, and I'm happy to answer questions there. Thank you for joining me today to learn more about Skeena and our Eskay Creek project.